Welcome back. Time for the business news. Singapore's key exports fell by a worse than expected 16.3% year-on-year in December, posting its sharpest drop in 14 months. Electronics shipments continued to be weak, dropping by 19.1%, while non-electronics exports also took a fall, down by 14.8%. However, some analysts say there is no cause for alarm, as the decline is to a high base effect the previous year.
Electronics continue to drag Singapore's export figures down, with PC parts and disc media products leading the declines. Singapore's exports to its top 10 key markets dipped in December, with the steepest declines seen in shipments to the US, South Korea and Malaysia. Singapore's exports also plunged much lower than economists' estimates of about 7.5%. But analysts note that on a seasonally adjusted month-on-month basis, the NODX has risen by 1.8%. Signalling a silver lining for the Singapore economy.
Judging from that, we may possibly see a marginal improvement in industrial production number for December compared to November. And if you factor that in your GDP calculation, then it actually reinforces the belief that Singapore will narrowly avert a technical recession in the fourth quarter.
The drastic drop of 16.3% can also be explained by a strong base figure the previous year, boosted mainly by the maritime sector.
Some of them also point to export competitiveness issues. The strong Singapore dollar, I think, is one issue. The fact that the electronic sector in Singapore tends to be skewed towards product categories that are not as high growth. So Singapore doesn't benefit as much from the growth in smartphones and tablets and other categories of that nature.
Meanwhile, bullish production figures arriving from China, South Korea and Taiwan are leading analysts to believe Singapore is still likely to achieve the government's full-year growth forecast of between 1 to 3% this year. They add that Singapore's tourism and construction sectors have also shown improvements.